All right, today we are diving deep into a really fascinating company, Keurig Dr. Pepper, or KDP. From an investor's point of view, this company is a total puzzle. You've got these incredible strengths on one side, pulling against some really significant risks on the other. So let's break down the bull versus the bear case.
But first, let me ask you a quick question. Think about it. If you had to name the #2 best-selling soda in the US last year, what would you guess? You're probably thinking it's one of the big colas, right?
Well, for the first time in a long time, you'd be wrong. In what was a pretty massive shift for the beverage industry, Pepsi actually got knocked out of that #2 spot.
The new runner-up? It was Dr. Pepper. Yep, that iconic, kind of quirky brand that's been around forever is the absolute engine behind the company we're looking at today. And that one surprising fact, well, it's the perfect way to start understanding what's really going on with this business.
See, to really get KDP, you have to think of it as two totally different businesses that just happen to be living under the same roof. You've got a powerful growth engine, and then you've got this heavy anchor that's kind of holding it back.
And when you look at where the money comes from, this becomes crystal clear. That U.S. refreshment beverages part, that's Dr. Pepper, Snapple, Canada Dry, all that stuff, it is the dominant force. We're talking over 60% of sales. Then you have the U.S. coffee business, the Keurig system, which makes up just over a quarter of the company.
And right here, this is the core tension of the whole story. While the beverage side is humming along, growing nicely, the coffee business is actually shrinking. This dynamic, this powerful beverage business, basically propping up a struggling coffee business, that is the key to understanding pretty much every big move KDP is making right now. So, okay, let's start with the good stuff, the bull case. Why would an investor get excited about KDP? Well, it goes way beyond just the top-line numbers. It's about some powerful, really hard-to-replicate advantages.
And it all starts right here. I mean, think about it. For 139 years, Dr. Pepper has built this incredible loyalty with people. It's not just a soda, it's a piece of culture, and you just can't buy that kind of brand equity. It gives them this amazing competitive defense, what investors call a moat.
But KDP's strengths go way beyond just one brand. The bulls will point to three main moats. First, that whole portfolio of iconic brands. Second, a distribution network that is a really scarce asset. It's incredibly hard for a competitor to build something similar. And third, the super powerful Keurig ecosystem.
And let's just talk about that ecosystem for a second. There are 40 million homes in America with a Keurig machine sitting on the kitchen counter. That is a massive, captive audience. It is the classic razor and blade model, right? You sell the machine, the razor, and then you make recurring high-margin money selling the K-Cup pods, the blades, for years and years. It's genius.
Now, the final piece of the bull case is how smart KDP is about growth. They are fantastic at finding these white space categories and jumping in. Just look at energy drinks. By partnering with hot brands like Ghost and C4, KDP went from basically zero market share to about 7% in just a few years. They captured all that growth without having to bet the entire company on it.
Okay, that all sounds pretty great, doesn't it? But there is another side to this coin. The bear case is just as compelling, and it revolves around some very real challenges and one absolutely enormous bet the company is making on its future. The problems really kick off with that coffee segment. Remember when everyone was stuck at home during the pandemic? Well, as people started going back to the office and to coffee shops, that at-home coffee boom just fizzled out. You add that to what the company itself calls record green coffee inflation, and you have some serious long-term pressure on that whole business. And the risks aren't just in coffee. This is a big one. The company just had to take a $718 million write-down on the value of its brands, and it was mostly for Snapple. Now, a charge like this is basically the company admitting, hey, this asset isn't worth what we thought it was. It's a huge strategic setback and a major warning sign about how hard it is to keep these older brands growing.
Which brings us to the absolute centerpiece of the bear case, this massive company-altering gamble. KDP has announced it's buying JD Peet's, a global coffee giant, for about $23 billion. And the plan is to then split this new, even bigger company into two separate businesses, one focused on global coffee and the other on North American beverages.
So, how are they paying for this? Well, here's the kicker. They're funding it with a mountain of debt. After spending years carefully paying down the debt from their last big merger, this one deal is going to nearly double their leverage. All that hard work? Just gone. It adds a ton of financial risk at the exact moment their coffee business is already struggling.
So what we have is this classic tug of war, a strong bull case built on incredible brands and a smart strategy, and a really serious bear case built on a struggling business segment and a super risky, debt-fueled acquisition. So how in the world does the stock market make sense of these two competing stories?
I mean, that's the billion-dollar question for any investor, right? With all this drama, all these pros and cons, how does the market actually price the stock? Let's look at the data.
When you put KDP side by side with its biggest rivals, a massive valuation gap just jumps off the page. On key metrics like forward price to earnings, KDP trades at a huge discount to both Coca-Cola and PepsiCo. The market is clearly much more skeptical about KDP's future earnings.
So why the discount? Is the stock just a bargain? Well, probably not. This isn't an accident. The market is pricing in the entire bear case we just talked about. KDP's smaller size globally, that much higher debt load, the massive risk that comes with executing a deal this big, and of course, the drag from that struggling coffee business.
So as an investor, this is where it all comes together. That discount, it could be a huge opportunity if you believe in the bull case and think the market is wrong. Or it could be a perfectly justified warning if you think the bears have it right. So what should you watch to figure out which story is actually winning?
Here are the 4 key things to keep your eye on. Number 1, watch that debt ratio like a hawk. Are they actually paying it down like they said they would? 2, are they still winning market share in those high-growth areas like energy drinks? 3, how is that massive JDE Peet's integration going? Are they hitting their goals? And finally, number 4, can they actually turn the coffee business around and get it growing again? At the end of the day, the answers to those questions will decide the fate of this massive pivot. Is this huge bet going to create a new global coffee champion and a more focused American beverage company? Or is the risk so big that they're about to create 2 weaker companies out of one pretty strong one? That is the multi-billion-dollar question investors will be watching very closely.